just a couple of things of housekeeping. If you go to the next slide, Marielle.
Yes.
We'll start with the talk from Eric. I'll introduce Eric in a minute. Most of you know him anyway. We then go into what we traditionally have as a safety moment, which we've morphed into very different topics. So this time, Marielle will go through diversity and inclusion moment, and after that we'll have 10 minutes or so, 15 minutes to talk about the chapter specific issues of nominations for the next election. I think Andrea is going to be able to talk to that for a very short while. Also wanted to highlight the fact that in Stavanger, the initiative is being planned to have a conference, a DADQ conference early next year. So just wanted to highlight that. We can very briefly touch on that. But the topic of today is, of course, Eric's story about the coming energy transition. Lots of people are interested for very good reasons. One of the best reasons for it is that Eric is a very good speaker. And I know Eric from, I don't know how many decades, but the first time I met him, he managed to make a pretty uninteresting topic, which was baseball, very interesting. So I think if he starts talking about very interesting topics, it's going to be superb. So I warmly recommend it, everybody to sign up for this, and very pleased to introduce Eric and to thank him for being willing to give this talk. So Eric, over to you.
Okay, thank you, Jan-Paul, and you can hear me okay?
We can hear you good.
All right. Well, I didn't know you were going to start out by insulting our national pastime over here.
It's the least I could do.
Yeah. So thank you very much, and thanks for the invitation, and thank you to everybody for joining. It's nice to see so many friends online, and I appreciate you taking time out of your day. I'll go ahead and share my screen, and I think, Jan-Paul, I think you might have to stop, or Marielle, you might have to stop sharing.
Yeah,
okay.
I have some now. It should be okay for you too.
You see this okay?
Yes, we do.
Okay. All right. So what thought we would talk about, given our focus, our professional focus is really helping others make decisions in complex settings. And I think there's some unique aspects of these decisions that we're making regarding the energy transition from a value metrics perspective. I think that's maybe different than some of the other investments we've worked on in the past. And I think it's an area where we can add a lot of value and help people think through that. So this is what I thought we would talk about: value metrics, and then going in more detail into the social cost of carbon. Okay. So in terms of a agenda here, I was going to just go quickly through decision quality. I think many people here online would be familiar with it, but perhaps there might be a few that aren't. And I just want to put it in context and put the energy transition decisions in that DQ context. And then some ideas for you on how to manage multiple value metrics. There's really a lot to be said there, and more than we can cover today, but I wanted to give you some pointers. That is a very active area of research and practice within the decision analysis and decision quality community. And then I was going to give you an example of, I think, where value metrics are important, and maybe a different metric than you might think of normally, which would be competitiveness. What do our emissions look like relative to others? Perhaps that's important. And then a little bit on where we are today on carbon pricing, and then talk about the social cost of carbon, just a little bit. Now, Paul, I'm getting just a tiny bit of background noise, or Marielle, if you guys can mute everybody, it might be helpful. Okay, so I think this is familiar to most of you, but again, the idea is we can't judge the quality of a decision based on its outcome. So how are we going to define what a good decision is? And there are many elements of what's needed to make a good choice. And that's the idea behind decision quality. Of course, framing, this is what problem are we working on? How are we going to approach it? Are we thinking about it straight? I think that's quite important in this energy transition framework and decisions in this space to make sure we're thinking about it squarely. The next piece is alternatives. And so your decisions know better than your best alternative. We've got to create good alternatives in order to make a good choice. Information, this is garbage in, garbage out. If we don't have good information, we can't make a good decision. And then values or objectives, which is what are we trying to achieve? Any decision you've ever made has these top three components. Your alternatives, what you can do, your information, what you know, and your values or objectives, it's what you want. So it's very much, I think, of an engineering approach to decision making. We like to break things down into components, and then we have to put it all back together, and that's the reasoning element. We have to do the analytics correctly and handle uncertainty correctly. And then the final piece is commitment to action. So making sure that we have the stakeholders involved and the decision makers involved and build in their commitment along the way. I think the ones I have highlighted in red are ones that I was going to emphasize today in these energy transition decisions. The value metrics is critical, or what are we trying to achieve? We might have multiple metrics. How could we trade those off? And then alternatives. And I think thinking about our values could lead to different alternatives. All right, so let's talk about managing of multiple metrics here. And to help walk through this, I've got three illustrative projects in mind that an oil and gas operator may encounter. And in this energy transition context, or reducing our carbon emissions context, one could be an asset swap, where we replace a profitable high carbon intensity field with a less profitable, lower carbon intensity field, but it has higher production. Okay, so the intensity is lower, but the production's higher. Maybe the total emissions will actually be greater. And this is where I think it's important to start thinking through the different metrics. Is it total emissions? Is it some measure of emissions per unit of output, like CO2 per barrel? Those could be different, and they could rank alternatives differently. And then the other metric here is profitability. The second notional investment is a solar PV investment, where if we install this, it's going to replace some on-site gas-fired generation. So we need power at the site. We're burning gas, natural gas, to do that. We're going to replace that with solar PV, which would reduce our total emissions, but at some cost. And then the third is a carbon capture and use or storage investment. And that'll reduce all emissions associated with gas-fired generation. Okay, so those are the three things I wanted to think about. Here's
sorry, Eric. I can still hear some people not having muted. Also, just wanted to highlight the fact that people can ask questions, put them on the chat box, and we'll post them at the right times to Eric as we go through it. But could you please mute if you aren't muted as yet? Many thanks.
Okay. Yeah, thank you, JP. Here's an influence diagram, or you might call it a decision diagram, for not an atypical, let's say, oil and gas asset investment. we're thinking about, should we invest in solar PV? Should we invest in CCUS? Should we maybe do an asset swap? And the things in red are our value metrics. So clearly we'd have NPV, and that's something that we're quite comfortable with and have dealt with in the past. There might be other financial metrics, capital productivity, maybe total capital spending. These are quite common in the projects that we tend to work on. I think what might be new is at least these three. Down here I have production. That could be a value metric, and maybe we're willing to trade off production against some of these other metrics. But this group of three here, I've got carbon emissions in terms of absolute emissions, so total tons of CO2 equivalent. Carbon intensity, so here I've measured that in terms of CO2 per barrel. And then perhaps our ES&G rating, so our environment, societal, and governance rating. And maybe that's a metric that we care about. And maybe these metrics are ultimately related to our bottom line, perhaps some are maybe not. And the question would be, well, what are the metrics? How should we quantify them? How should we measure them? And then how should we trade them off amongst each other? If they're really both or all of these are direct value metrics, then we have to be able to specify how we might trade them off. And there's different ways to do that. Okay, so it's the value metrics component, which I think is a new component of these energy transition decisions. Here's some illustrative, it's been disguised, this is based on a real project, but some disguised data regarding how these different alternatives do on the different value metrics that we identified. So the asset swap, on balance, that's a negative NPV for us. So if it was just an NPV decision, we wouldn't do it. Solar PV, it actually has a positive NPV. Perhaps there are some incentives that make it so, but for whatever reason, that has a positive NPV. And then the carbon capture and storage has a negative NPV. And I've highlighted here the alternative that does the best on that particular metric. We have capital spending. The asset swap has the lowest degree of capital spending, carbon capture the highest. Capital productivity, perhaps that's NPV per dollar capital. Probability of success, I added here, so we think it's quite likely we could implement this solar PV project successfully. Probably could do an asset swap, but CCUS, perhaps not. Maybe the technology is not in place yet, or we don't have a repository for the CO2, or we don't have the pipeline network to move the CO2 to where it would need to be. But some uncertainty if we could bring that to fruition. Production, total production in millions of barrels per day or per year. And so the asset swap, our production actually goes up a little bit. Solar PV carbon capture, there's no impact. Our incremental CO2 emissions, carbon capture is going to reduce those the most. Solar PV a bit. And the asset swap here, I'm assuming, has no incremental impact. Has a lower carbon intensity, as you can see below, 85 grams of CO2 per megajoule. But because we have increased production, the total emissions stay the same. And so when you look at this, it's really not clear which alternative we should pick, how we should balance these different value metrics, at which rate we might be willing to trade them off. And so that's what we want to talk about. Now, one way to handle it would be assigning a monetary value to CO2. And of course, that's the idea behind some of the different regulatory schemes. And if that was done, then we would have a price that we could use, and we could get things down perhaps to a single metric like NPV. In this particular case, you can back out that if you prefer solar, that implies you're putting a value on carbon of less than $130 per metric ton. If you choose carbon capture, then it's higher than that. And then the asset swap we would never do if it was just based on NPV. And so we could back out our trade-off based on choices we might make, but it'd be better to make that trade-off explicit and consistent across the company, right? We wouldn't want to use one value of CO2 on one project and a different value on another project, because then we're going to find that we're making inconsistent investments. So here's one way you could start to think about making these trade-offs clear for us and then clear for decision makers. Here I have a cost of carbon per dollars per metric ton of CO2, and I'm just looking at a sensitivity analysis. I'm just saying, well, what if the price of carbon was zero, then we'd prefer the solar PV project because it had a positive NPV and the others didn't. The carbon capture was -50. As we increase the price that we're putting on carbon, the asset swap's value doesn't change because the total emissions don't change. But solar and carbon capture become more valued, and they cross over at some point when if the price on carbon is high enough. This would be a way of providing some information to decision makers and thinking about, well, how should we balance the financial and the environmental impacts. I'm going to go into more detail on this in the last section, but the idea behind a social cost of carbon is you could think of it as the present value of all the economic damages that are going to be caused by emitting one marginal ton of CO2. So if you added one additional ton of CO2 to the atmosphere, and you could track over time the damage caused by that, and we took the present value at some discount rate, then we would have a cost associated with adding that ton of CO2 to the atmosphere. That would be the idea behind a social cost of carbon. It's more complicated than that, but I think at a high level, that's what it means. Just to give you a little flavor, and then I'll go into more detail. The current estimates are in this ballpark for the social cost of carbon. This is coming from one particular model called DICE, and it's dynamic integrated model of climate and the economy, developed by William Nordhaus, who recently got the Nobel Prize for this work. And that model produces something on the order of $40 per ton of CO2, and then it would be increasing over time. There's some key uncertainties in that model, and I'll elaborate on those in the last section here, and you can see them here. So that'd be another way that we've put a formal price on it. Another way to make this trade-off, and this is something that we often do, would be we could quantify, let's say we care about emissions reductions total, and then capital expenditures, and we could rank the projects in terms of bang for the buck. Solar PV reduces emissions by 0.5 million metric tons at a cost of around $30 million in CapEx. Carbon capture, we get greater emissions reductions, but at a much greater cost. And then the asset swap doesn't reduce our emissions at all. This would be like a portfolio trade-off plot that you might think of making in other settings. This would be another way we could provide information to decision makers and help them think about these trade-offs. Essentially, it's a measure of efficiency. For a given level of cumulative or capital spending, how much are we getting of what we want? And here what we want is emissions reductions. Now, probably the most, the most sophisticated way to do this, and the closest to the, I would say, the correct way of doing this, short of a model where we price everything out and put everything into some common numeraire like dollars. Short of that, we could create something we call a multi-attribute value function. And the idea there would be you would put weights on the different metrics that you care about. So NPV, incremental emissions reductions, and the carbon intensity. Let's say we care about those three metrics. It's not just total emissions, we also care about intensity. And what I have here is a 2x2 plot that implies the third weight, because these weights would have to sum up to 1. And so what I've done here is I've rescaled these. Solar did the best on NPV, and it becomes a 1. CCS did the best on incremental emissions, it gets a 1. And then the asset swap is best on carbon intensity, it gets a 1. And then these others are in proportion to that. This is how they perform on these dimensions. Over here is the weighting that we're applying. If we put 100% on emissions reductions, then we would go with carbon capture because it's the best there. And the other weights, the weight on NPV would be 0, and the weight on carbon intensity would be 0. Up here, I've put no weight on emissions reductions. I put all the weight on NPV. And then of course, there's no weight on carbon intensity. And then I would choose solar. And this plot shows all the possible combinations of these two weights, with the third one being implied, and which alternative would be preferred. It's going to be quite helpful if maybe we don't know the weights, or we just have some information, like we think, well, the weight on emissions is less than 0.4, then it might narrow down the alternatives that could be possible. Or if we think the weight on emissions is between 0.4 and 0.6, then that would rule out the asset swap, right? It would either be solar or carbon capture. There's a lot to be said about this, and to make sure that you do it correctly. It's not just a simple weight and rate. You have to develop these scales carefully and correctly. You have to think about this multi-attribute value function. For example, is it additive? Do we just weight these and add them? There are other value functions that have a multiplicative nature to them. And so I want to make you aware of this. At the same time, I want to caution you that there's lots of ways to do this wrong. And you want to make sure you spend the time to get it right. But that could be an approach that boils all these different metrics down into a single metric. So I think other considerations that we might take into account would be like how well do different asset level decisions roll up and align with company targets? How is our approach, our methodologies positioning us relative to our peers? What type of economic regulations might we face in the future? And getting these wrong could have a big impact. Another thing we might be concerned about is maintaining our license to operate, and how do all of these combine to help maintain our license to operate? Okay, so I'll go to unless there's any question on that section, JP, I'll go on, or Mary Ellie, to the next section. I'm going to go through a particular example. Okay. Yep. Is there a question?
Well, Marielle at work, do you want to ask one of the questions that have been posed as yet, or you want to keep those in reserve?
I think there is at least one that could be answered now. Sorry, can you hear me okay?
Yes.
Yeah, so there were 3 questions on the chat. One was very specific about the swap calculation. So when you were talking about that example, there was a question that came. It says, do you include a carbon cost for the asset swap calculations?
So here for the swap, I have how it does on each of the metrics. So the NPV here has no carbon price.
So you don't have one, okay.
And it's separate. The carbon impact is separate down here. So it lowers our carbon intensity of our portfolio, even though it doesn't lower our absolute emissions. And I think this is something that's quite interesting. Do you care about total emissions, or do you care about your carbon intensity? You could lower the intensity and not have any effect on the total emissions, and that's what happens here.
Yeah. Okay, there is another one related to similar topic, and Jean-Paul, you put that in the chat. You perhaps want to do it yourself as a question.
Yeah, I was just wondering if you, for instance, if you sell an asset and that's a way to reduce your emissions. The reality is that the emissions aren't reduced. So how do you? I mean, somebody else produces them. So how do you deal with that from a framing point of view?
Yeah, so I think that's quite important here in terms of who's the decision maker. Is it us, this as a company, or is it society? And I think, yeah, in a lot of these situations, who the decision maker is can make a difference with the alternative you end up with. I mean, for example, subsidies may not, from a societal perspective, you know, let me just say here in Austin, okay, there's subsidies to put solar on my house. From a societal perspective, they don't make sense because they impute a cost on CO2 that is much higher than it is. But it's good for me to do it. So I think it would be context specific, Paul. Maybe it lowers our ESG rating and improves our company, even though it doesn't reduce total emissions. I think that'd be up to the decision maker.
Yeah.
Okay.
And another one quick, Eric, before you move on to the topic from Becky Watson here. So Becky, if you want to be unmuted and do the question, okay. If not, I could just read what you put in the chat. Let me see if Becky.
Hey, Marielle. Yeah, hi, Eric. So in a scenario where you are sequestering on behalf of an industrial hub, for example, then how do you deal with the fact that CO2 is going to be produced likely with some variability? For example, if you have power station in play, and you may be either limited on what you can put into the subsurface, or perhaps you can accommodate that in some way. But given that there is a variability in rate that you are consuming CO2, and that may be seasonal, for example, how do you should your value or cost of CO2 vary over the course of the year? What would you do with that?
So the way I would think about that, and maybe this could change if I got into the specific project, but to me, it's not a value metric question. There's uncertainty about either the rate or the volume that we're going to be able to take, and so that would be an uncertainty here. And when we are taking CO2, then we're getting some payment, either direct or implied, because there's a price on carbon. And so when I go to evaluate that alternative, I would have already accounted for the variability, because I'm not giving myself any credit for taking the CO2 when I can't. Does that make sense? So I wouldn't put
thank
it,
you.
yeah, I wouldn't put it in a value. The fact that one alternative maybe is more certain than another, like in terms of how much CO2 it could take, I think that should be reflected in the uncertainty distribution around the value of that project.
Thanks, Eric.
Okay. All right, so let me go here. This section, I want to highlight this idea of carbon competitiveness, which I think is interesting and important and could result in different recommendations. This is for California, is the example here. And in California, they have a renewable fuels standard where they quantify the total carbon emissions of gasoline from the well to the wheel in this value chain. And so, for example, 11 grams of CO2 is produced per megajoule of gasoline. Okay, in total, it's 100 grams about of CO2 per megajoule of gasoline. About 10% of that's coming from production, 1 gram from transportation, 15 grams from refining, about 0.5 gram from the refinery to the service stations, and then 3/4 of it occurs when the fuel is combusted. And what California has done has they've established a baseline for production and transportation carbon intensity, and then refiners have to pay, or they incur credits, they generate credits or deficits depending on if the source of crude they're using has a higher or lower carbon intensity than the baseline. Okay, so around 12 here. This is a plot of what I would call the carbon intensity supply stack, crude supply stack in California. This is 2018, total volume of crude supplied to California refineries in millions of barrels in 2018. And then this is this carbon intensity measure of production and transportation in terms of grams per megajoule in 2015. They update this number every 3 years, and I must have 2018 available, but I don't think 2021 is out yet. And then the dots are different fields. Okay, so at the very front here is some really low carbon production, which a lot of it is in the California or in the Los Angeles basin. So this is an interesting environmental trade-off question here. We have very low carbon oil and crude, but in a more populous region. How do you make those trade-offs? Then it increases. Here you have Saudi Arabia. This is after it's been transported to Los Angeles or to the refineries in Northern California. So this includes transportation, production and transportation, around 10 grams per megajoule. The baseline is around 12, as I showed you on the prior screen. And then you get some very high carbon intensity crude. This is primarily California heavy oil and Canadian tar sands. And then here's US Alaska. The median carbon intensity is around here, around slightly below, or right at 10 grams per megajoule. And then this is the estimated demand for crude oil in California in 2030. Now, what's going to come off of this supply stack, I think, is a complicated question. But if there is a price on carbon, then perhaps some of these assets on the right would be at risk. And so we could think about moving our position on this supply stack. Here we are. Let's say we have a heavy oil asset, and we're currently at the P95 in terms of carbon intensity. If we put in solar, let's suppose it reduces our intensity by this amount, this absolute amount, but it has hardly any impact at all regarding our relative competitiveness in terms of carbon intensity because of where we are to start with, right? Whereas if we were down here, if we had a field that was light oil, we're already at the P50. If we install solar, then for that same amount of reduction in intensity, we can move up to the P10, for example. So from a competitive standpoint, where you were sitting currently is going to make a big difference as to perhaps whether you should pursue the investment or not. Okay, here's an asset swap. Instead of doing solar PV, if we did an asset swap, which had a negative NPV, not as good. Solar has a positive NPV, but it has almost no impact on our relative competitiveness, where if we move into different assets, then it could have an impact. So that's what I wanted to highlight here. I think different metrics are going to have different implications. Absolute metrics are going to potentially have different implications than relative, like intensity metrics. And then even taking those metrics and thinking about our position relative to others in maybe a competitive environment like this could have different implications. Okay, let me talk a little bit about carbon pricing. This is a slide that just about the greenhouse effect. That's, I think, kind of helpful to understand. There's really two types of radiation that are important. So shortwave sunlight and then long wave heat. We get about 340 watts per square meter from the sun. So like 300 watt light bulbs per square meter. About a third of that's immediately reflected back into space from the atmosphere, from clouds. About 23 watts is reflected by the surface. 161 watts is absorbed by the surface, and then about 80 watts is absorbed by the atmosphere. When it's absorbed, it then re-radiates heat in all directions. And so some of that heat is re-radiated to the Earth's surface, and the imbalance is around a watt per square meter, a little bit higher probably now since this was created. Okay. And the idea then behind a carbon tax would be there's an externality, right? When I drive, I am putting CO2 into the atmosphere, and that CO2 is going to have some cost, potentially some benefits, right? But on balance, it's believed that it'll be a net cost. And the idea behind a carbon tax would be, let's internalize this externality. And then once that's done, then perhaps the market could find efficient solutions here. This is what percentage of global greenhouse gas emissions are covered by some type of a cost on carbon. You can see not a lot until 2005. And then it's increased, and it's around 16% or so of global emissions are now covered by some type of a cost. And a big part of that is the EU trading system. This is a plot of the price on CO2 for different countries. This is in US dollars per ton of CO2 equivalent. Here's Sweden, so it's around 130 a ton. You can see it decreasing. The EU ETS, the time we put this together, was around $20 a ton. California has a price on carbon. And then the blue dots are what fraction of that region's emissions are covered by a tax. So you can see that there are markets that are trying to be developed, and you can see the prices that are associated with some of those. And I think what you'd like to do is compare this to what is the social cost of carbon, right? If If we don't have any price on carbon and it causes damage, that's not going to lead to the right economic decisions. At the same time, if you have a price on CO2 that's too high, then that's not going to lead to the right decisions that we need to make. And so we'd like to think about what is the right price. As you know, I think a lot of people on here know that many companies, this list has probably grown since we put this together, but are supportive of carbon pricing or have announced targets to reduce emissions. There was a piece in the Wall Street Journal in 2019 of, it was, quote, the largest public statement of economists in history. It was, I guess, good to get so many economists to agree to one thing, but they signed a letter arguing that there should essentially be some kind of a price on CO2. All right, and so that's the next section. How do you put a price on CO2? There's a paper, a number of papers in this area, but this is one that we wrote recently, and I'm happy to send a link to it if people are interested, or if you want to email me directly, I could send you a copy of it. But what we do here is we look at one particular model, this DICE model, and analyze how its estimates of the price of carbon have changed over time. Okay, I covered this slide, so let me talk about this. This is how DICE works. It's a very simple, what's called integrated assessment model. It runs in Excel. I have an Excel version of it that I built. The more powerful version runs in something called GAMS, which includes some optimization elements to it. But it's the kind of model that we would build on a project, right? We take very much of a systems perspective, and we treat things in a kind of high level way and put emphasis on making sure that we have the whole problem. And that's DICE. There are decisions around emissions reductions. This is how much we should reduce emissions through time. And then there's different components. There's an economic model or module that relates economic growth to energy use to CO2 emissions. Then there's a very simple carbon cycle model. The Earth is modeled as 3 layers. There's the deep ocean, the upper ocean, and then the atmosphere. And this models how CO2 moves among those reservoirs. And then there's a climate model, which relates CO2 concentrations to temperatures. And then there's a simple damage model that relates increased temperature to economic damage. And what DICE does is it balances. If we reduce energy use, we might lower economic growth, but that also lowers climate damage. And there's a trade-off there. Or if we spend money on abatement, that's going to lower economic growth. Could have spent that on something else. And it balances those two effects. So if you're interested in this, if you go to Amazon and just William Nordhaus has a number of books, a few of which are written for the general audience. Climate Casino is one that came out a few years ago. This damage model, it has to be very high level. And what it does is it tries to synthesize, calibrate itself to what's known about climate damages and the relation of climate damages to temperature. So a lot of work goes on behind the scenes to fit this function that relates damage to temperature increase. And as I showed you earlier, this is what comes out of the model. And it's very sensitive to the discount rate, as you can appreciate, because we're talking about damages in the far future. And so the lower your discount rate, then the higher, the more value you're going to be placing on these future damages, so you're going to get a higher amount. At a 5% discount rate, the social cost of carbon from DICE is estimated to be $15 a ton. If you use a 2.5% discount rate, then it'd be $77 a ton. And you can see the ranges here. And I think ideally we would use something like this to set our carbon prices within a company, for example. And then we could use this carbon price on our projects, and we would just roll a price on CO2 into the project economics like we do any other portion or cost associated with the project. This price has changed a little bit over time, so you're going to expect it to increase. Nordhaus has it increasing in real terms, so you'd expect it to increase just because of inflation, but also expect it to increase over time. And what we do in this paper is we say, essentially, we shouldn't be surprised by this because, as you guys can appreciate, this is a single number from a distribution. There's a lot of uncertainty here. And so we shouldn't be surprised if when the model gets updated and we learn more that the number changes. An important input to that is what's called a climate sensitivity. And this is how much the Earth would warm for a doubling of CO2 concentrations. And that's from pre-industrial times. So if you double CO2, the 10th percentile is around 1.5 degrees Celsius would be the average warming. It would be different around the globe, but this is the average. The mean is 3 C, and the P90 is around 5 C. And this is what we might call the tail risk, right? And clearly portions of this tail would be very, very damaging, right? And there's a lot of uncertainty on this number. That uncertainty really hasn't decreased over the last 30 or 40 years while we've been studying climate change. This uncertainty in this number is about where it was. There's a lot of other uncertainties that are inputs to DICE that are uncertain. I won't go through them all, but let me just highlight some. One is how productive the economy is. Here's the climate sensitivity. This is uncertainty regarding the relationship between temperature and damage. That is uncertain. What's the population of the Earth going to be? That sort of asymptotic population of the Earth. What's the total fossil fuel resource? There's uncertainty on these things. When you put distributions on those, or at least 1090 ranges, you can get a tornado diagram on the social cost of carbon. This is for the 2013 DICE model. The base case is around $24 a ton. But you can see if CO2 is a lot more damaging than we expect, then it could be around $37 a ton. If it's less damaging than we expect, around $10 a ton. The climate sensitivity is a big uncertainty. If we're on the high end, then we'd have costs, approaching 40 and so on. Those are really the big drivers there. There's other things that, don't make as much of a difference. And we could put that all together and then get a distribution on the social cost of carbon. And so the P50 is around 20, P90 around 40, but it could be higher. It could be up around 60 or 80. This was the estimate in 2016 from DICE. This is the red's the 2013 model. 2016 they updated it, right, and the price went up. Sometimes people say, well, that shows the model's not good. I mean, in my view, it's just we're learning and the number's going to change. It tends to go up, if nothing else, for inflationary reasons. So, okay, so Marielle, you asked to leave 10 minutes here for questions, and I pause there and I could take questions on any of the topics we talked about.
Yes, that's great, Eric. So we have few in the chat. So there is one from Jean-Paul. Jean-Paul, you want to come off mute?
All right. Yeah, you had a chart with the a huge difference per country in terms of the amount of emissions that you apply the tax to. Yeah, that's the one. I was just wondering what, in your view, drives the difference in uptake in where you, is that a political thing? Is it a, the mechanics of how it works, whether it's a sectorial CO2 tax? Could you give your views on that?
Okay. Yeah, I think it's probably fairly complicated, and there might not be just a single reason. I think things that would matter would be probably the carbon intensity of the industries in that country would certainly be important. So the degree to which having a price is going to be detrimental potentially, right? If we have very high intensity CO2 industry, I think certainly political forces within the particular country are going to make quite a big difference. I think if you've seen, differences between California and the rest of the U.S., probably the degree also to which CO2 could be damaging to the countries as well, I think would make a difference. So some countries will be net beneficiaries of warming to some degree. Right now, of course, runaway warming won't benefit probably anyone, but the degree to the point at which the benefits are exhausted are going to be different for different countries, and I think that could also play a role.
Great. So should we go to the next one? So Bart has a question as well. Bart, would you like to come in?
Yes, I've had a question regarding the discount rate. I was wondering whether it's appropriate to use a discount rate over and above inflation, given that you're talking about a very long time horizon here, and the current decision makers are not necessarily the same people who will be affected by it later on. So in a way, what we're doing, we're making decisions for future generations. So in that context, is it correct to have a high discount rate above to account for the difference between real and nominal?
Yeah, so there's a lot of debate around this particular point, as there long has been in environmental types of decisions. So an argument for a lower, there's two dimensions. Okay, I think there's like there's an equity argument and an economic argument. Some have argued for essentially zero real rate, let's say maybe just equal to inflation. Another argument for a higher rate would be, look, the future is going to be wealthier than we are. And because of that, we should use a rate that reflects really market opportunities. The future needs a good climate, but the future also needs other tangible infrastructure. And if you don't use an appropriate discount rate, if you use something too low, then you're going to over invest potentially. So Bart, it's a thorny issue, and there's kind of ethical and economic arguments. I personally lean more towards, along with Nordhaus, of using market rates for these kinds of investments. So, because enforcing anything other than a market rate is going to be, I think, also hard.
Great. We have another here from Warwick. Warwick, would you like to come off mute? Let me see. Is it Warwick connected? Oh, I think we haven't got him.
I seem to be double muted for some reason. Okay, sorry. Hi, Eric.
It works.
I guess my question is founded in just looking at some of the actual numbers here that are coming out of the DICE model and the numbers that are actually on the screen in front of us in terms of the social cost of carbon. I mean, you're seeing things from sort of $15 to, let's call it 120. And yet, you know, when I think about, say, the price of gasoline at the pump in the UK, if I did my calculations correctly, I think we're paying something like $320 a ton in the tax that's already in the gasoline price at the pump. Now, that's not thought of as a carbon tax because most of that is an excise tax that goes off into the general fund. But the effect, I would have thought, would be the same in terms of regulating the demand. So I guess my question would be, well, maybe there's two questions. One, what makes a tax a carbon tax? And related to the, you know, specifically in the UK, are we not driving enough? Is our demand for gasoline too low because of these high rates?
So I put up a slide here. I had it back up from a poll that we had done. I don't have the poll set up, but yeah, $40 per ton social cost of carbon. I did this for the US, so sorry, you know, in terms of miles and dollars, but
yeah,
that's like 30 cents a gallon in terms of the cost there. So yeah, if it's, you know, if you have a tax higher than that,
yeah,
then,
I think we're in for about $3.80 a gallon. I think round numbers what we're paying here.
yeah. So then, you know, there would have to be other non-carbon reasons, you know, for that potentially. I mean, if it's just carbon, then you're misallocating resources. I mean, you're spending more on it than you should be spending on it.
So what's the definition of a carbon tax then? I mean, what's the difference between a carbon tax and a tax on carbon, if you want to put it that way? Does it have to do with the revenue needs to go back into actually paying for the damage done?
Well, that's yeah. What you do with the revenue is another complex issue that maybe starts to get outside of my expertise. But in the U.S., the talk has been of a neutral tax, so that whatever collected from a carbon tax would be refunded through reductions in some other tax. What makes something a carbon tax? I don't know. I think just there's a direct cost on the quantity of CO2 associated with some activity. So you know, you could have a higher fuel tax for other reasons, right? You want to reduce congestion, right? There's other externalities.
Or it's just a great way to collect revenue for the government.
You know, there's other externalities associated with driving besides just carbon, right? Like when you get on the road, you make it more crowded. So you should have to pay for that in theory. That's why you'd have toll roads.
Yeah, I guess I'm struggling a little bit to just think that maybe I mean, I'm thinking about the UK specifically, that, I mean, strictly speaking, that if we're paying this much carbon tax, which is effectively, you know, a lot more than the social costs that are listed here, it would suggest that we're not, you know, we're under consuming this resource. And it just doesn't feel, I don't know, to me, it doesn't kind of feel that is the case, which makes me question whether those social costs of carbon are too low. I mean, I guess that's it isn't sort of passing the field test to me. It feels like we probably should be driving and emitting less rather than more.
Well, it wouldn't be the first time that you know, the government has not set the price of something correctly. So yeah.
Yeah, no, for sure.
Okay, we have one more question. If we could accommodate this one, if you can stay with us for a few minutes, Eric, just one more.
Sure.
Yeah, so
Hi,
Daniel. Yeah.
Hi, Eric, Daniel here. As far as I see, the DICE model is basically looking for an optimum between abatement costs, so basically costs, the cost of the transition versus the economic costs of the effects of climate change. So it's a cost, finding the cost optimum. How does the DICE model calibrate? I mean, from my perspective, I see two observations. A is the abatement costs tend to be overstated. So it forecasts seem to be too pessimistic in terms of how much the abatement will cost. Look at the battery costs, for example, for vehicles, what the predictions were a couple of years back and how fast the costs are going down. Look at the PV costs, how fast this go down. On the other side, how does the model calibrate the economic damage? Here, there are two effects. One is that the effects of climate change itself seem to be getting stronger. So IPCC, for example, increases the level of sea rise levels, etc. So we're nearing towards. And the other effect is the forecast of economic damages also seem to be underestimated. There were lots of reports last year where it says, why do we underestimate the costs of all the climate change topics? And one of the arguments was economists, if it's a difficult prediction to make, especially in a politically sensitive topic like climate change impact, and since there are so many new developments where you have difficulties putting a price on it, economists sometimes referring to put any cost on it. So they know that there is something happening, they know that there is a cost on it, but they put zero cost in their economic models because they don't do this. So in the end, it seems to me that in order to get this model right, you need to recalibrate these two effects. Is something like this happening? Do you see this? Do you share the same observations?
Sorry, Daniel, I'm muted for a sec. So I would just say a lot of work goes into calibrating the model to the latest findings regarding the cost of climate change, the damage associated with that. And so every time they come up with an update, they're trying to match that. And the same thing in terms of abatement costs. And it does have a learning kind of curve in it where costs are going to come down. Now it's a model, and it's a very simple model. If you look into it, you might be surprised about how simple it is. For example, damage is quadratic in the temperature change. So basically damage is alpha times t squared or delta t squared. And so you're summarizing a whole lot of effects that are not necessarily temperature dependent, like ocean acidification. But it's summarized by a change in temperature because perhaps it's correlated with temperature. As CO2 goes up in the atmosphere, it goes up in the ocean, and it results in higher temperatures. But it's a simplification, and so I think, from my perspective, it's more like getting in the ballpark of what the numbers could be. I don't think you can defend any particular estimate, but is it $200 a ton? I don't know. It's hard to see that coming out of DICE, but you could maybe argue it. I think the other thing the economists do is they price everything out, and there's a certain fungibility assumed between climate capital and tangible capital, in that we can kind of take capital out of the climate in the form of putting more CO2 into the atmosphere. And as long as we put that into tangible capital and human consumption, DICE is okay with that, makes the trade-off. Maybe that makes some sense, like in the body of the distribution here. I kind of worry, like on the extremes here, is that really that degree of substitution really makes sense? And I think a more of a multi-attribute approach, like a decision analyst, like we might approach that problem, I think could be, could be fruitful.
Okay, thanks.
Yep. But yeah, read about DICE. Get Nordhaus book, and you guys can follow it and let me know what you think.
Climate Casino. I quite like the title of that. Intriguing.
Yeah, that's a good one to start with. He's got a bunch, but that's a good one.
Okay. All right, let's open the floor if there are any other questions.
I think we covered all the ones in the chat, but if anyone wants to just unmute themselves and ask, that's absolutely fine. Just a couple of more minutes.
Okay. Can I, this is Xinjing, can I ask a question?
Yeah, go
Yes.
ahead.
Yeah, seems all the trade-off we're talking about is between NPV and a ton of CO2. In the front end of the presentation, you brought up three concepts. One is total CO2 emission, one is NPV, one is the carbon intensity. How do you include in the intensity in this conversation of the trade-off? Of course, one is a society level, one is a business level, but I'm just curious how to think about it in terms of framework.
Yeah, I think that's a good question. DICE is all around just dollar per CO2, so it has no notion of intensity. From a societal perspective, I'm not sure if we care about intensity directly. We care about the total, because the atmosphere doesn't care what the intensity is, just cares about what's going in. So I think intensity, the way I've been thinking about it, is more from an individual company perspective and a competitive perspective. If we lower our carbon intensity, then perhaps it gives us access to other opportunities that we didn't have before. Maybe it helps maintain a license to operate. And we can keep operating these fields, maybe, if we reduce the carbon intensity. And if we don't, then maybe we're not going to be able to. And so how to put a value on it, I think, is challenging. You could model it explicitly. If we lower our carbon intensity, then we think we're going to have access to all these other opportunities that we wouldn't have had before, right? In theory, you could try to model it, but I think that would be tough. What I would tend to do is probably carry along multiple value metrics and just make some kind of a trade-off, like I was sort of showing here, or like here. In my practice, if there's multiple metrics, I usually, let's just carry them along and let's not talk about the trade-off unless we really have to, right? If one alternative is better on all these metrics, then we don't have to think about the trade-off. If it's not, then we're going to have to get into it. And when you get into that, that's where it can be really thorny. And I try to avoid that kind of thing unless I, really have to.
Thanks, Eric.
Okay.
Just a follow-on question on that. It's interesting that that's exactly the tax that California has raised. They focus on the intensity. So maybe it's just a very acceptable way of sort of turning the squeeze on a particular segment.
Yeah, they're trying to drive the use of renewable fuels, feedstocks, to create gasoline, because then the intensity would be zero. They have a whole different formula for every kind of feedstock. And so, yeah, I think it's maybe not the most economically efficient, but it seems to be like politically possible, now. I wouldn't be surprised to see something like that in the US at some point, but so, yeah, other questions? Okay. Well, thank you for inviting me. Hope that was useful.
Eric, it was a pleasure to see you, and thank you so much for making the time. I know this is a topic that you've talked about before, so you must be pretty passionate about it. Thanks for sharing your experience and your wisdom here.
Thank you.
Much appreciated.
Yeah, thank you for inviting me, and look
All
forward
right.
to hearing from everybody. So,
Thank you.
Okay.
yeah.
Great. Thank you, Eric.
Okay.
Thanks.
Okay.
All right, Marielle, can you?
Yeah, let me go back.
The next topic is for you, so maybe you can share your moment.
Give me just a second to see if I'm sharing the right screen. And John Paul, if you could let me know what you see, that would be great.
I see some sort of a process.
Wet gas piping system. There you go.
Yeah, it just came with my my stuff. So let me just make sure I got it all right. Apologies for this. I'm still getting to you know, be ready to use Zoom properly, and I'm not quite succeeding. But I think Zoom is much better than Teams anyway. Okay. So what I'm going to do now is I'm going to go through the rest of the agenda. But first, I would like to point you guys to the recording of our previous session. So last time we got together, we had a session, a panel session on agile and decision quality. If you remember, some of you were there. The recordings are now available in the website of the Decision Professionals website. It's easy to find. You just go there and then the drop-down menu from all the chapters, and you will find London. Once you click in London, it will take you to the events, and it should be there. The link is here, and obviously it's easy to share with you when we send out the slides, but it's also very easy to find if you go to the website. I would like to apologize for the quality of the recording, since I didn't do a great job at doing it professionally, or probably better, but I think you will be able to capture most of the conversation if you missed it, or if you want to go back through it again. Okay, so let's go to, let me see if this is going to move. Yeah, so just quick on the agenda. So we've done our talk, and now we're going to have a quick look at a video that I pulled from a diversity and inclusion moment that we were discussing in our team before. And it's just a very short 2 minutes, and I hope it does come across well. So let me know if it doesn't. And then we're going to go into our more specific points for the chapter. So for those of you who want to leave because you were here just for Eric, that's absolutely okay. You don't need to listen to the video, the 2 minutes video that is coming. If you want to stay, excellent. And then we will go into the business as usual, and it will be led by John Paul. So let me fire up the video. And I hope this time around you're not looking at the process. Why are you looking at the process?
Yeah, we're looking at the process now.
Okay, give me a second because my mouse has gone crazy. There you go. And ignore this and go to the presentation back again. And hopefully I will be able to pick this. Okay. So I'm gonna fire up the video. It's all about unconscious biases. And I think we all had meetings in the past to talk about similar topics and what we've seen what having unconscious bias could mean in terms of decision making. And I wanted to bring back one short video that is basically focusing on how we challenge the assumptions that we make based on biases that we could have. So I wanted to have this just before Eric, just to open your mind about, well, we're going to think differently here. Eric is going to talk to us about assumptions that we made in the past for the analysis we do. Perhaps we need to start shaking that mentality, and it will help us to start moving from those assumptions that are made by our brain, by the way we've been, approaching decision making, not only strategic decision making, but also our decision making in our daily life. So I wanted to have the video, but it was better to have Eric first. So that's probably a little bit out of place at the end, but the intent is to open us to that mindset, to remind us of how important it is to remove biases, and how important it is to consider diversity of thinking and including different perspectives when we want to solve a complex problem such as the one that we are facing now with the climate change, and looking at how we actually value carbon. So I hope you find that related in a way. So let me just find the video. Okay, it's not playing ball. Okay. a second. Finally, I can see the mouse coming back. And I should bring this in. It's going to take me longer to fire the video than actually what it lasts, to be honest, guys. Okay.
Arielle, the problem with it is that we can't hear the sound.
Can anyone else hear the sound?
No, Marielle, I think when you share the screen, there's a little tick box somewhere down under that says share the audio.
Oh, I tried this before and it worked. Give me a second then.
So you may have to unshare and then reshare the screen.
Okay, apologies for that. Okay, so computer sound. And now it should be okay. And I will just go back and play.
Are you seriously considering her as a candidate?
Just don't trust
She's a woman.
She's a
This is a
woman.
man's
She's
job.
clearly not educated.
Really not Does she even speak English?
That's not me. I'm not like that. You call it an honest mistake. Science calls it a blind spot. Our unconscious mind is a mysterious and powerful thing. It makes 90% of our decisions without us even knowing it. Our brains are overloaded with 11 million pieces of information every second. Yet we can only process about 40 of them. So we're wired to make cognitive shortcuts, using past experiences to make assumptions. And you know what happens when we assume. Our unconscious mind can put us on autopilot, determining where we sit, who we eat lunch with, who we turn to for advice, and who we choose to offer a helping hand. Living our lives with blind spots can put us in a tunnel. Same point of view, same decisions, same outcomes. We can find ourselves trapped in the land of snap judgments and misconceptions. We've all been on both the giving and receiving end of blind spots. Think about it. Who's talented? Who's able? Who can I trust? Who belongs? We've all been there. Blind spots are part of the human condition. Our choices have consequences for us and the people we interact with. By accepting that blind spots exist, we can stop. Imagine what possibilities exist if we could do it all over again. Different perspectives, inclusive relationships, diverse networks, better outcomes, seeing people for who they really are. People like you, with unlimited potential. We all have blind spots. Once you accept that you have them, you can choose to do something about it. It's time to check your blind spots and focus on what's possible.
Okay, so did you guys get to see that?
That was good, Marielle. Thanks.
Yeah. Okay, I'm gonna go onto the video because we probably need to start getting into the section, but there are quite a few of the ones there that are relevant and probably interesting to look at. Not only challenging the assumptions, but how we can enhance objectivity when we're looking at decisions and planning for more complex problems where we could benefit from that. How to overcome stereotypes as well, and also one that is very short but really nice about how to broaden perspectives. And I will put the link later. So that's all I had. So Jean-Paul, you want to go back to the agenda unless anyone has any comments about this? Anything to add?
Yeah, I would like to have a comment. This is yours. Hi. Just today, by coincidence, this morning I saw an ad that I saved on my computer. I think it was from Microsoft, and you can do these kind of blind spot tests, and you can do it for gender blind spots or for skin color blind spots. And they have a very interesting class that takes maybe like 10 minutes. And they show you pictures in a very fast frequency. And then you have to press certain buttons. And then it does kind of a mapping. Just a coincidence that I did it today. And I want to look into it more. So I can't really tell you a lot because I just tried it out once. But I think it's an interesting subject and fits very well with the movie you just showed. If I have something, I will send it around.
Oh, that's great. Please.
Yeah, thanks, Joost. Interesting. We haven't got we have a couple of minutes left. We've got about 10 minutes left. Marielle, could you share the last slide that we had?
Yeah, let's see if this time I succeed to this. That I'm lucky. Okay, so now in theory, I should be sharing the presentation. So you saw the website. Okay, is that coming through?
Yep. Yep.
Perfect. So let me go back to the agenda. Yeah.
So if you can do the last, just the last slide.
Okay. Give me a sec. This one.
Yeah, thanks. So just first, just to let you know that that in Norway, Stavanger, they're planning to do a DA-DQ conference. In the past, it's been pretty successful. There was a EDPN organized a conference in Amsterdam. Then we had a conference in Copenhagen. 2 or 3 years ago, we had a conference here in London. They've been pretty successful. So it's great that they have that initiative. And just wanted to make everybody aware of that. So